क्या करूँ अंकुर में बताओ। हाँ नहीं, आप कह रहे थे ना कुछ कट हो रहा है। नहीं, इन्होंने येलो पहना हुआ है, ग्रीन नहीं है, येलो है। तो नहीं तो इनको कुछ पहना देता हूँ मैं ऊपर, कुछ और। ग्रीन 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 देखो देखो आप, मैं सजा रहा हूँ, आप देख लेना। चलिए ये डालिएगा।
ये तो ग्रीन है।
कोई बात नहीं, डालिएगा।
ग्रीन तो पिछली बार मना किया था इन्होंने।
सर ये येलो है ना, ये तो बिल्कुल बहुत ज्यादा ब्राइट है ना।
ये बड़ा मुश्किल है, ड्रेस कोड तो बंद ही नहीं होगा।
देखिए सर, कुछ कुछ काम बनेगा, से भयानक लग रहा है। हाँ हाँ हाँ। एक और ऑप्शन है मेरे पास, है ना। सीधे डालिएगा।
तो आएगा ही नहीं हमारे।
थोड़ा बहुत सर, थोड़ा बहुत तो बस आप पहन के बस।
नहीं आएगा यार,
आएगा ही नहीं बिल्कुल।
हाँ।
जाएगा तो सही, थोड़ा तो जाएगा सर।
एक तरफ ही जाएगा, दूसरी तरफ जाएगा ही नहीं।
करके देखिए, शायद चला जाए। नहीं, ये तो आ ही नहीं रहा शायद, उसी से चलने देते हैं फिर।
हमने सोचा पीला मना नहीं है, इसलिए पीला पहना। गुड मॉर्निंग। Process of structural analysis. The process of structural analysis in security analysis typically involves the following steps. Number one, define the objective. The first step in the process is to define the objective of the analysis. The objective should be clearly defined and aligned with the investor's investment strategy and goals. Number two, collect data. The next step is to gather data on the company and the industry in which it operates. This data can be sourced from financial reports, company filings, industry reports, news articles, and other sources. 3. Conduct financial statement analysis. The analysis of financial statement involves reviewing the income statement, balance sheet, and cash flow statement to assess the company's financial performance and financial health. This includes examining key financial ratios such as profitability ratios, liquidity ratios, and solvency ratios. 4. Conduct management analysis. In this step, the quality of the company's management team is evaluated, which includes their experience, qualification, and track record. The analysis assesses the quality of the management team. Number 5, conduct industry analysis. This involves assessing the competitive position and growth prospects of the industry in which the company operates. The analysis includes analyzing the industry trends, market share, competition, and regulatory environment. 6. Company valuation. In this step, the intrinsic value of the company based on its financial performance and growth prospect is analyzed. This may involve using a range of valuation techniques such as discounted cash flow analysis or comparable company analysis. Industry analysis. Industry analysis is the process of examining the current and future trends and conditions of a particular industry to identify opportunities and potential challenges. This analysis typically includes studying the competitive landscape, market trends, customer preferences, and regulatory factors that may impact the industry's growth and profitability. There are several approaches to conducting industry analysis, including the following. Number one, Porter's five forces analysis. This framework examines the competitive forces that shape an industry, including the threat of new entrants, the bargaining power of suppliers and buyers, the threat of substitute products or services, and the intensity of rivalry among existing competitors. Number two, SWOT analysis. This analysis looks at the strengths, weaknesses, opportunities, and threats facing an industry. This can help companies identify areas where they can improve and leverage their strengths to gain a competitive advantage. Number three, pest analysis. This framework looks at the political, economic, social, and technological factors that impact an industry. This can help companies anticipate changes in the business environment and adjust their strategies accordingly. Industry analysis is important for companies to understand their industry's competitive dynamics, identify potential opportunities for growth, and make informed business decisions. It plays an important role in security analysis for decision making. Steps in industry analysis. Industry analysis is a systematic examination of the factors that influence an industry's performance and prospects. It is an important tool for businesses to understand their industry's competitive dynamics, identify potential opportunities for growth, and make informed business decisions. An industry analysis typically involves the following steps. Number one, defining the industry. The first step in industry analysis is to define the industry being analyzed. This involves identifying the products or services produced by the industry, the target market for these products or services, and the key players in the industry. Number two, gathering industry data. The next step is to gather data about the industry. This includes information about market size, growth rates, industry trends, and the competitive landscape. This data can be gathered from a variety of sources, including industry reports, government statistics, and company filings. Number three, analyzing industry trends. Once the data has been gathered, it is important to analyze industry trends. This involves identifying patterns and changes in the industry over time, such as shifts in consumer preferences or changes in government regulations. Number four, conducting competitive analysis. Competitive analysis involves assessing the strengths and weaknesses of the industry's key players, as well as their strategies and positioning in the market. This can help businesses identify potential competitors and opportunities for differentiation. Five, assessing opportunities and threats. Based on the data and analysis conducted, it is important to assess the opportunities and threats facing the industry. This includes identifying potential risks such as changes in consumer behavior or technological disruptions, as well as potential growth opportunities. And last one, making informed business decisions. The final step in an industry analysis is to use the information gathered to make informed business decisions. This may involve identifying areas for investment or disinvestment, adjusting marketing strategies, or developing new products or services. It is an important tool for businesses to gain a deeper understanding of their industry and make informed decisions about their strategy and operations. By conducting a thorough industry analysis, businesses can identify potential opportunities and risks and position themselves for long term success. Now, the next part of counseling, company analysis. Company analysis is the process of evaluating a company's financial and operational performance to determine its strength, weaknesses, opportunities, and threats. Rather, you may say SWOT analysis, and is like a structural analysis. This analysis helps investors, financial analysts, and other stakeholders make informed decisions about the company. There are several aspects of company that can be analyzed, including number one, financial performance. This includes evaluating a company's revenue, profitability, cash flow, and financial ratios, such as the debt to equity ratio, return on equity, and current ratio. Number two, competitive positioning. This involves analyzing a company's market share, its competitors, and its ability to compete in the industry. Number three, management team. This includes evaluating the leadership team's track record, experience, and ability to execute the company's strategy. Number four, industry trends. This involves understanding the trends in the industry in which the company operates, including technological advancement, regulatory changes, and customer behavior. Number five, growth potential. This involves assessing the company's potential for growth, including its expansion plans, new product offerings, and potential for market penetration. Six, corporate governance. This includes evaluating the company's board of directors, executive compensation, and shareholder rights. By analyzing these aspects of a company, stakeholders can gain a better understanding of the company's overall health and potential for future success. Now, next part, valuation of stock. A common valuation measure is book value, which is the net worth of a company as shown in the balance sheet. Book value can be expressed per share basis, and in such a case, the book value per share is equal to net worth divided by the number of shares outstanding. The book value is derived based on certain accounting assumptions. These are number one, assets are valued after deducting the depreciation value from the acquisition cost. Number two, depreciation amount of an asset for a period is computed based on the initial estimated life of the machine. There is no guarantee that the amount provided as depreciation is equal to loss in the value of the assets, and it may be either more or less than the actual loss in the value of the asset. Number three, the market price of a stock takes into account the market value of the assets. Another measure close to book value is liquidation value per share. This represents the amount of money that could be realized by breaking the firm, selling its assets, repaying debt, and then distributing remainder to the shareholders. If there is an active takeover market, the price of the stock should be at least equal to the liquidation value. Otherwise, corporate traders should find it profitable to acquire the firm and then take up liquidation. Value of a firm can also be measured by computing the replacement cost of the assets less debt. Replacement cost can be measured if you could find out what is the current cost of putting up a similar plant. Forecasting earning per share, EPS. Earning is the most important number in valuing the stock. The most important and the principal source of getting information about the earnings of the company is its financial statements. Out of the two statements, namely balance sheet and income statement, it is the income statement that is more often used in order to assess the future state of the firm. The income statement of the past few years shows the kind of growth that the company is witnessing on sales and earnings. A comparison of income statement of the company vis-a-vis income statement of the industry shows the market share of the firm. There are various methods employed to assess the future outlook of the revenue, expenses, and earnings of the firm given the economic and industry outlook. These methods can be broadly classified into two categories, namely traditional and modern. Traditional methods of forecasting EPS. The following methods of forecasting are adopted: return on investment approach, ROI approach, market share approach, and independent estimates approach. ROI approach. Under this approach, attempts are made to relate the productivity of assets with the earnings. That is, returns earned on the total investments are calculated and estimates regarding earning per share are made. Simply stated, return on assets equal to EBIT upon assets. EBIT, earning before interest and taxes, divided by assets. Return on assets is a function of the two important variables, namely turnover of assets and margin of profit. In other words, return on assets equal to assets turnover multiplied by profit margin, whereas assets turnover equal to sales upon assets and profit margin equal to earning before interest and taxes divided by sales. And when we multiply these two things, or we multiply sales of assets into earning before interest and tax upon sales, sales is cancelled, and the formula remains earning before interest and tax divided by assets, which is written here. Market share approach. This approach emanates from the industry analysis. Once the estimate about the future prospect of the industry is completed, the analyst would then look into the firms which are the leaders and pace setters in the industry and would then find out the market share of the firm to be analyzed. The following steps can be adopted to implement this method. Number one, estimate the industry's total sales. Number two, estimate the firm's share in the total sales in industry, that is market share. Number three, estimate the profit margin. Number four, multiply sales by profit margin to get total earnings. Number five, divide earnings by number of shares outstanding to get EPS. And number six, multiply EPS by PE ratio, profit earning ratio. In order to estimate the profit margin under this approach, the analyst has to understand the markup and behavior of cost and prices during the relevant range of activity. Last one, independent estimates approach. Under this approach, each and every item of revenue and expense is estimated separately and summed up to arrive at the future EPS. All the three approaches are traditionally utilized by security analysts. However, these are not mutually exclusive approaches. But one important and common limitation of these approaches is that they indicate point estimates of EPS and HPY and therefore attach 100% probability of outcome. Now, modern methods of forecasting EPS. Under modern approaches to forecasting, earning of a company, statistical techniques are used. The following techniques are generally included in this category. First one, use of regression and correlation analysis. Number two, use of trend analysis. And number three, decision tree analysis. First one, regression and correlation analysis. In order to find out the interrelationships of relevant variables, the techniques of regression and correlation analysis are used. When the interrelationship covers two variables, simple regression is used, and for more than two variables, multiple regression technique is used. Using this approach, security analysts may find out the interrelationship between the variables belonging to the economy, industry, and company. For instance, if the analysts believe that the sale of firms depends on GDP growth rate, gross domestic product growth rate, monsoon, and population growth rate, then it is possible to set a relationship between sales and other independent variables by collecting the data pertaining to sales and other variables for the last few years, say 20 years. Once the data is ready, a regression model can be set out to find the relationship and that can be used to predict the sales. Major advantage in its application relate to deriving the forecasted value as well as testing the reliability of the estimates. Now, second one, trend analysis. While using this technique, The relationship of only one variable is tested over time using the regression technique. In a way, it is the simple regression technique where the interrelationship of a particular variable is tested vis-a-vis time. That is why the name trend analysis. It is quite useful to understand the historical behavior of the variables for the purpose of the security analysis. And last one, decision tree analysis. The above two methods are considered superior to the traditional methods employed to forecast the value of earning per share. However, an important limitation remains. Both these methods provide only point estimate of the forecast value. In order to improve decision-making process, information relating to the probability of occurrence of the forecast value is quite useful. Thus, a range of values of the variable with the probabilities of occurrence of each value will go a long way to improve decision by the investor. To overcome these limitations, decision tree and stimulation techniques are used. Under the decision tree analysis, the decision is assumed to be taken sequentially with probability of each sequence. Thus, in order to find out the probability of the final outcome, given various sequential decisions along with probabilities, the probability of each sequence is to be multiplied and summed up. In practice, whenever security analysis attempts to use decision tree analysis in conducting analysis of the securities, she or he start with estimating the sales. Now, financial analysis. Financial analysis is the process of evaluating the financial health and performance of a company by examining its financial statements and other financial data. Financial analysis is an important tool for investors, creditors, and other stakeholders to make informed decisions about a company's investment potential and creditworthiness. Financial analysis typically involves the following steps. Number one, reviewing financial statements. Financial statements such as income statements, balance sheets, and cash flow statements provide a detailed picture of company's financial performance over a period of time. Reviewing these statements is the first step in financial analysis. Number two, calculating financial ratios. Financial ratios are used to analyze the relationship between different financial statement items. Common financial ratios include profitability ratios, liquidity ratios, solvency ratios, and efficiency ratios. Number three, conducting trend analysis. Trend analysis involves examining financial data over time to identify trends and patterns in a company's financial performance. This helps investors and other stakeholders to identify areas of strength and weaknesses in a company's financial performance. Number four, comparing financial data. Comparing a company's financial data with its peers in the industry can provide valuable insights into its financial health and performance. Investors and analysts may use benchmarking techniques to compare a company's financial ratios with industry averages. Number 5, conducting sensitivity analysis. Sensitivity analysis involves testing the impact of changes in key financial variables such as interest rates or commodity prices on a company's financial performance. This helps investors and other stakeholders to assess the potential impact of external factors on a company's financial health. Financial analysis is an important tool for investors, creditors, and other stakeholders to make informed decisions about a company's investment potential and creditworthiness. By conducting a thorough financial analysis, investors can identify potential risks and opportunities associated with investing in a company's securities and make informed decisions about their investment portfolios. Now, technical analysis. Technical analysis is concerned with a critical study of the daily or weekly price and volume data of the index comprising several shares like Bombay Stock Exchange Sensitive Index, that is Sensex, or of a particular stock. The objective of the technical analysis is to predict or forecast the short, intermediate, and long term price movements. It uses only the data generated from the markets. Such market generated data includes price, volume, number of trades, 52-week high or low price, intraday spread, dealers buy sell quote spread, number of advances and declines, number of stocks hitting the new high and low, open interest, etc. Some of the basic assumptions of the technical analysis are: number one, market value is determined solely by the interaction of supply and demand. Number two, supply and demand is governed by numerous factors, both rational and irrational. Number three, stock prices tend to move in trends which persist for an appreciable length of time. Number four, changes in trend are caused by shifts in demand and supply. Number five, shifts in demand and supply can be detected through chart analysis, and some chart patterns repeat themselves. Types of charts and patterns. Charting represents a key activity for the technical analysis. The two oldest and most widely used charting procedures are point and figure charting and bar charting. The major features of point and figure charting are: number one, it has no time dimension. Number two, it disregards small changes in the stock prices. And number three, it requires a stock to reverse direction a predetermined number of points before a change in direction is recorded on the chart. P and F charts were used earlier because it is easier to graph manually, because it considers only prices on days when there is a major change, and in that process it uses roughly about 20% of the total number of shares. On the other hand, Bar chart contains measures on both axes, price on the vertical axis and time on the horizontal axis. On the bar charts, rather than just plotting a point on the graph, the analyst plots a vertical line to represent the range of prices of the stock during the period. The length of the bar represents high and low prices of the day, whereas the open and closed prices are shown as a small ticker on both sides of the bar. Methods of technical analysis. Technical analysts broadly use two methods to analyze the stocks to find whether it is worth to buy the stock or sell the stock or hold the stock. In the first analysis, the analysis uses the price chart as it is to find trends and patterns. In the second approach, the analysis convert the market information into certain statistical figures and draw conclusion. We will first discuss the pattern before moving into statistical analysis. Analysis of price patterns and trend. As already mentioned, the analysis used the charts made up of historical price, volume, and other market generated data to understand the minds of major players in the market and the demand and supply position of the stock. It is also assumed that the prices react to the news, but the reaction is not instantaneous, but takes some time to fully reflect the value of the information to the prices. Though the time and speed of the adjustment process differ depending on the type of the information and its availability to the investors. They could be broadly classified into certain patterns, and this knowledge could be used subsequently to predict the future behavior of the prices. The analysis of patterns is the first principle in the technical analysis, and the success of this method of analysis of stock prices depends on the ability of the user in recognizing the patterns. Market indicators. Technical indicators help not only to predict individual stock price behavior, but also the trend of the market. Some important price, volume, and other indicators of market are highlighted below. Price advances versus declines. By comparing number of shares which advanced and those declined during a certain period of time, one may know what the market is really doing. The difference between the advances and declines is called breadth of the market. The technician is generally more interested in change in breadth than in absolute level. Further, breadth may be compared with a stock market index. Normally, breadth and the stock market index will move in unison. However, when they diverge, a C signal occurs. During a bull market, if breadth declines to new lows, while the stock market index makes new high, a peak in the average is suggested. The peak will be followed by major downturn in stock prices generally. High, low, or differential index can be used as a supplementary measure to breadth of the market. In theory, a rising market will generally be accompanied by an expanding number of stocks attaining new highs and a dwindling number of new lows. The reverse will hold true for a bearish market. The volume of short selling, which refers to selling shares that are not owned, can be useful indicator of the market as well as for individual stock. Short selling, or as it is called short interest also, can be related to average daily volume. The short interest for a period, say a month, divided by average daily gives a ratio. This ratio indicates for many days of trading it would take to use a total short interest. Historically, on the New York Stock Exchange, NYSE, and the American Stock Exchange, AIMEF, the ratio has varied between one third of a day and 4 days. In general, when the ratio is less than 1, the market is considered weak or weakening. It is common to say that the market is overbought. A decline should follow sooner or later. The zone between 1 and 1.5 is considered a neutral indicator, while above 1.3, 1.2 or 1.3, value above 1.5 indicate bullish territory with 2 and above highly favorable. This market is said to be oversold. A rise should follow sooner or later as oversold market. Odd lot trading, which can be measured by constructing an odd lot index by relating odd lot purchase to odd lot sales, that is, purchase plus sales, can indicate the direction of the market. As technicians feel that the odd lots are inclined to do the wrong, rising index indicates rising market and falling index indicates falling market, which in effect mean selling proportionately less at or near the market peak and selling proportionately more before a rise in the market. Mutual funds, cash as a percentage of net assets on a daily or weekly or monthly basis has been a popular market indicator. The theory is that a low cash ratio, say about 5%, would indicate a reasonably fully invested position, leaving negligible buying power, indicating that the market is due for climb down. High cash ratios indicates possibilities of market climb down. Elliott wave theory. The Elliott wave theory is a technical analysis tool used by traders to forecast financial market trends and identify potential trading opportunities. It was developed by Ralph Nelson Elliott in the 1930s and is based on the idea that market trends and movements follow a repeated pattern of waves. According to Elliott's theory, markets move in five ways in the direction of the larger trend, followed by three corrective waves against the trend. These waves are labeled as impulse waves and corrective waves, respectively, and are named with numbers and letters. For example, 1, 2, 3, 4, 5, ABC. Here, 1, 2, 3, 4, 5 are the impulse waves, and ABC are the corrective waves. Counter. The impulse wave 1, 3, 5 represent the direction of the train and tend to be longer and stronger than the corrective waves 2 and 4. Means there is increase 1, then some decrease, then again increase 3, then some decrease 4, and then again a steep increase 5. But after this, there will be correction, and the corrective waves ABC represent a counter trend move, which is usually shorter in duration and less powerful than the impulse waves. Or you may say that in the long run, market will go up. Elliott wave theory can be used to identify potential entry and exit points in the market based on the direction of the trend and the waves that have been completed or are currently in progress. However, it is important to note that the theory is based on subjective interpretations of market movements and should not be used as the sole basis for making trading decisions. It is a technical analysis tool used to analyze financial markets, including stocks, commodities, and currency. It is based on the idea that market trends and movements follow a repeating pattern of waves, which can be identified and predicted with a high degree of accuracy. The five impulse waves and three corrective waves form a complete Elliott wave cycle. The pattern can repeat itself in a self-similar way with smaller waves composing larger ones. Limitations of technical analysis. The theory serves only as a starter so far as Indian conditions are concerned. Let us review each of the basic tenets of Dow theory one by one. The averages discount everything. This is valid even in India. The most popular depictions of average are simple moving average, average of close, high, or low price for a given period, and exponential moving averages, which extend the average over the entire record, assigning more weight to the most recent data. Moving averages of 30 days or 5 weeks depict short-term trend, and moving average of 200 days or 14 to 40 weeks depict long-term trend. The crossover of two averages indicate that the trend is changing direction. For instance, if the 5 weeks moving average crosses the 14-week moving average from below to above, it indicates beginning of bullish phase and may define buying opportunities. The reverse is true if crossing is from above to below. The market has three movements. There are primary, secondary, and minor. Elliott wave theory is the most popular depiction of this principle. It states that the markets moves up in five waves, that is five up or five down, namely three moves up and two down, while it moves down in 3 to 5 waves. These waves are primary, secondary, and tertiary, superposed on each other. And it takes experience to separate the three movements. For instance, an upward movement of a primary wave comprises five secondary waves and so on. Price bar charts indicate movement. This is true, but moving averages record the daily or weekly fluctuations and bring out the trend more reliably. Price volume relationship provide background. Unfortunately, volume data are not reported in India, and the volume data of specified group shares, wherein forward trading is allowed by the exchanges, is published after delay of several weeks. Since forward trading is no indicator of the actual market activity, these relationships are of little value in India. Price action determines the trend. This is true in India as well. The average must conform. This is based on the premise that if one group of activity, say manufacturing, does not trend in the direction of another group, say transportation, it indicates an oncoming change of trend of the market. In USA, data about different activities is regularly published. For instance, utilities average and transportation average. However, in practice, there is no widespread acceptance to such analysis, and typically the focus is on individual stocks. Insider manipulations are rampant in the Indian stock market. Such manipulations are encountered in USA also, but they are few in numbers, and the culprits are caught and punished. In the Indian stock market, it is not unusual to find that the price of a share doubled in few days and fall back to its original value a few days later. All these malpractices leave their mark on the prices of stock. Thus, one can suspect whether the charts represent the true balance of the demand and supply forces. Hence, it is possible that some of the technical analysis techniques suitable in other markets may not be suitable in India, and indicators evolved for American conditions may lead to erroneous conclusions. It is always desirable to do extensive research and experience before taking up technical analysis based investment decisions. Alternately, one can subscribe some of the technical analysis services offered by experts in the field. Fibonacci analysis. Fibonacci analysis is a popular technical analysis tool used to identify potential support and resistance level in the financial markets. It is based on the mathematical sequence defined by Leonardo Fibonacci, an Italian mathematician in the 13th century. In Fibonacci analysis, traders use the Fibonacci sequence to identify levels of potential support and resistance in a market. The sequence is as follows: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, and so on. Each number in the sequence is the sum of the two preceding numbers. For example, 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, 3 plus 5 is 8, 5 plus 8 is 13, and so on. 34 plus 55 is 89, and 89 plus 144 is 233. The Fibonacci sequence is used in technical analysis to calculate Fibonacci ratio, which are key levels in a market. These ratios are calculated by dividing one number in the sequence by the number that precedes it. The most commonly used Fibonacci ratios in technical analysis are 0.0236, that is 23.6%, 0.382, that is 38.2%, 0.50, that is 50%, 0.618, that is 61.8%, and 0.786, 78.6%. Now, next part, which I think we will not be able to take wholly, but I give you some starting considerations regarding this. Valuation of securities. Valuation of security is the process of determining the intrinsic value of a financial instrument such as stock, bond, or derivative in order to make informed investment decisions. The intrinsic value is the true worth of the security based on factors such as company's financial health, economic conditions, and market trends. The valuation of securities is an essential part of the decision-making process for investors, as it helps them to determine whether a security is overvalued, undervalued, or fairly valued. If a security is overvalued, it may be too expensive to buy, while an undervalued security may present a buying opportunity. There are several methods that can be used to value securities, including discounted cash flow analysis, price to earning ratio, and price to book ratio. Each method has its strengths and weaknesses, and the choice of method will depend on the nature of the security being valued and the purpose of the analysis. The valuation of securities is an important tool for investors who seek to make informed investment decisions. The time value of money is a financial concept that recognizes the fact that money available at different times has different value or worth. It is the idea that a rupee received today is worth more than a rupee received in the future, because money today can be invested or earn interest, while money in the future cannot. The time value of money is based on the concept of opportunity cost, which is the idea that the cost of using money is the opportunity to earn a return on that money. For example, if you have rupees 100 today, you could invest it and earn a return. Whereas if you don't have that rupees 100 until a year from now, you miss out on the opportunity to earn a return during that year. In finance, the time value of money is used to calculate present value, and future value of cash flows. To determine the net present value of investments and to determine the appropriate interest rate for loans and other financial products. It is a fundamental concept in finance, and understanding it is essential for making informed financial decisions. Present value. Value of an asset is equal to its present value of its expected return. This is true particularly when you expect that the assets you own provides a stream of return during a period of time. This definition of valuation also applies to value of security. To convert this estimated stream of return to a value of security, you must discount the stream of cash flows at your required rate of return. The process of estimation of value requires the estimated stream of expected cash flows and number two, the required rate of return on the investment. The required rate of return varies from security to security on account of differences in risk level associated with securities. Present value is a financial concept that represents the current value of a future sum of money, discounted to reflect its value in today's money. In other words, present value is the amount of money that would need to be invested today in order to equal a future sum of money, assuming a certain interest rate or discount rate. The calculation of present value is based on the time value of money principle. This is actually mathematically the formula of compound interest. Here, present value is principal, future value is amount divided by 1 plus rate. Rate is rate of interest and n is the number of years. Example is given. If you want to find out the present value of rupees 10,000 at 5% rate of interest, it will come to 8762.89. That's all. Namaskar.